Inflation isn't cooling by accident, it's being slowed by three silent brakes you never voted on. And the fourth brake is about to change who wins and who loses. You've felt the shift already. Groceries aren't exploding like they did in late 2022. Used cars that were impossible to find now sit on lots with price tags that don't make you gasp. Your landlord sent a renewal offer that didn't jump 20% this time. But your paycheck still buys less than it did in 2019. Your credit card interest is punishing. And you're wondering, why is inflation slowing now? And what happens next to your rent, your mortgage, your investments, your job? The headline says inflation is down from around 9% in 2022 to near 3%. But your life isn't a headline. Here's what's happening to you right now. That refrigerator you delayed, those plane tickets you hesitated on, the car you thought you missed, prices are softening in some places, still sticky in others. The reason is hidden in how money, time, and measurement collide. But here's the twist. The number you see on the news is dragging a shadow of last year behind it, and that shadow is about to fade. Picture a small-town bakery. In 2021, flour shortages, trucking chaos, and wage spikes slammed the owner. She raised prices, paid signing bonuses, and still couldn't hire enough people. In 2023, the story flipped. Her flour supplier finally delivered on time. Shipping went from, "We have no pallets," to "We'll get it there tomorrow." Customers started resisting $10 croissants. She ran a 2-for-1 deal, not because she wanted to, but because higher interest rates made every credit card purchase feel heavier and her foot traffic slowed. Multiply that by millions of businesses. That's why some prices are easing before your eyes. So, what are the three silent brakes? The first is the demand brake. The Federal Reserve lifted interest rates from near 0 to over 5% at the fastest clip in 4 decades. That's not abstract. If you looked at a $400,000 home at a 3% mortgage, your payment was around $1,700. At 7%, it's roughly $2,600. That $900 shock freezes moves, cancels upgrades, and crushes impulse buys. Auto loans that used to carry 3% now sit near 7 or more, pushing a monthly payment up by hundreds. When big-ticket items slow, businesses feel it and stop raising prices like it's a sport. And this is where things get interesting. Higher rates don't just hit you. They hit companies first. Debt they refinanced cheaply in 2020 comes due at much higher costs. CFOs slash spending, delay expansion, and push suppliers for lower prices. That pressure flows from boardrooms to your cart. The second brake is supply healing. During the pandemic, a shipping container from Asia could cost $15,000. Today, depending on the route, it can be under $2,000. Ports unclogged, factories caught up, chips came back. That single piece missing from your car's dashboard? It's finally arriving. Oil that spiked over $100 a barrel cooled well below that peak. Diesel eased, which matters because diesel moves everything you buy. When bottlenecks unwind, goods stop behaving like collectibles and go back to acting like products. Wait, it gets stranger. The third brake is math. Base effects. If prices leapt last year and grow slowly this year, the year-over-year number suddenly looks tame. It's like climbing 2 flights of stairs, then 1. You're still higher than the lobby, but your heart rate drops. But here's what nobody tells you. The single biggest piece of the inflation basket, shelter, lags reality by 6 to 12 months. New leases across the country cooled hard in late 2022 and 2023. Apartment data sets like Zillow and Apartment List showed rent growth falling to near 0, even negative in some cities. Yet the official shelter index kept printing high numbers because it measures what people are paying across all leases, not just today's new ones. Translation: the slowdown you don't see on the screen yet is already baked into the pipeline. As that lag catches up, Reported inflation keeps drifting down even if everything else stays the same. Remember the bakery? She's not getting hammered by egg prices anymore. Eggs spiked, then normalized. That's base effects in your fridge. But she's still paying more than 2019, just not rising as fast. That nuance is the difference between slowing inflation and falling prices. Here's the part that changed everything for me. Not all inflation is created equal. Goods inflation, the TVs, laptops, furniture, has cooled or even gone negative in spots as inventories piled up. Services inflation, the haircuts, insurance, rent, restaurants, runs on wages, and time. Watch this chain. Job openings surged to over 12 million, then sank closer to 9 million. The ratio of openings to unemployed people peaked above 2-to-1 and eased down. Fewer openings mean less leverage for job hoppers. Wage growth cools from over 6% toward the 4s, and service businesses stop hiking prices every quarter. When wage growth and rent growth cool together, services inflation loses its fuel. But there's a catch. Health insurance in the inflation report uses a peculiar methodology that reset and temporarily showed large declines in 2023. That kept the services number softer than your premium actually felt. When it rebases, it can bump the numbers even if nothing real changed in your policy. Measurement quirks aren't sexy, but they move markets. Let's zoom out and then back in. Money supply surged in 2020 and 2021 as stimulus checks and business supports flooded accounts. In 2023, broad money actually contracted for the first time in decades. Less money sloshing around plus higher rates equals fewer bidding wars. Corporate profit margins, which ballooned in 2021 from scarcity pricing, started to compress. You saw it as discounts at big box stores and limited time sales that never seemed to end. The fever broke. Now the twist beneath the twist. Slowing inflation doesn't rewind prices to the old world. Disinflation is a slower climb, not a downhill ride. The gallon of milk that went from $3 to $4.50 may hover around $4.60, not slide back to $3. That's why your budget still feels tight. The power move is understanding the new slope. So where does this go from here? 3 paths matter. The glide path. Inflation keeps cooling toward the 2s or low 3s as shelter data catches up. Wage growth settles, and goods stay calm. In that world, mortgage rates drift down from the 7s into the 5s. Housing activity unfreezes, and your raise starts to outrun price increases. The bump path, energy spikes, shipping lanes get hit, or a new supply shock pushes goods up temporarily, lifting the headline even as the core trend softens. That feels like whiplash at the pump and a bump in airfare. The rekindle path. Demand re-accelerates because growth stays hot, and fiscal spending remains high. Wage growth turns back up, and services inflation refuses to fade. That risks rates staying higher for longer than anyone wants. Which one wins? Watch 3 dashboards you can check from your phone. First, new lease rents from Zillow or Apartment List. If new leases keep flatlining or dipping, shelter inflation in the official data will keep falling with a lag. Second, wage growth from the Atlanta Fed wage tracker. If it slides toward the 3s, services pricing power fades. Third, supply stress signals like global shipping costs or the supplier deliveries index. In manufacturing surveys, easing signals more disinflation spikes warn of bumps. And this is where things get personal. If you carry variable rate debt, credit cards, adjustable mortgages, floating business loans, you've been paying the Fed tax. Step 1. Attack that balance. Call and negotiate a lower rate, transfer to a zero-interest promo if you can, or consolidate into a fixed-rate personal loan. Even trimming 3 points on a $10,000 balance can save hundreds in a year. If you have a fixed mortgage under 4%, protect it like a rare painting. Your loan is an asset. Thinking of buying a car or durable goods? The leverage has shifted back to you. Inventories are better, financing is expensive for dealers too, and manufacturers are chasing volume. Walk in pre-approved, let the silence do the work, and watch the price move. For travel, flexible dates and midweek flights matter again, because fuel volatility is the new swing factor. But here's the twist you can profit from. When inflation is slowing and rates are peaking, long-duration assets start to breathe. That includes high-quality bonds that got hammered during the hiking cycle. A small shift down in expected inflation can lift their prices. If you hold cash in a savings account paying 5%, enjoy it. But know those yields can drop fast on the other side of peak rates. Consider laddering certificates of deposit across 6, 12, and 18 months to lock some yield without guessing the exact turn. If you rent, use the lag to your advantage. Pull local new lease data and bring it to renewal. New leases in this building are going for $1,800. I'm at $2,000. I'd like to renew at $1,850. Landlords hate vacancy more than they love a few extra dollars. If you own a rental, budget for slower rent growth and consider offering small concessions to keep good tenants rather than chasing the last $50. For investors, balance matters. Inflation-linked bonds hedge the risk of a surprise flare-up. High-quality stocks with pricing power handle mild inflation well, but sky-high multiples suffer if rates stay elevated. Cash isn't trash while it pays 4 to 5%, but idle cash will lag once yields slide. Build a mix that assumes the glide path but prepare for a bump. And don't miss this final layer: inflation expectations. When people believe inflation will stay high, they demand raises, front-load purchases, and businesses lean into price hikes. When expectations fall, the behavior that fuels inflation fades. Surveys show expectations cooling. That means the psychology is working in your favor. So yes, inflation is slowing because 3 breaks, higher rates, healed supply, and base effects are grinding on the system. The 4th break, lagging shelter, is still pressing down, and as it catches up, the headline should keep easing. But power comes from seeing the map, not just the mile marker. Your moves are clear: kill variable rate debt, lock good yields while they last, negotiate rent with data, time big purchases during inventory gluts, watch rents, wages, and supply stress like a hawk. If the glide path holds, you'll feel it as your raise finally outruns your grocery bill, and as the mortgage rate you're quoted next spring starts with a 5, not a 7. If a bump hits, you'll recognize it early and avoid overreacting. If demand reignites, you'll lean into inflation hedges before the crowd. The hidden truth is simple: you don't need to predict perfectly. You need to prepare intelligently. Remember that bakery owner? She's still charging more than she did in 2019, but she stopped hiking every month and she's competing again. That's the economy cooling without freezing. That's why inflation is slowing. And what comes next depends on choices made in kitchens, boardrooms, and your living room. People who treat inflation like weather get soaked. People who read the pattern carry an umbrella, leave 5 minutes earlier, and arrive dry. Now you do.